Welcome to In-Depth for a look at what is making mining headlines in the Americas. Equinox Minerals has made a hostile offer for Lundin Mining. But what does this mean for Lundin's plan to merge with Inmet Mining? Mining Weekly's deputy editor Lizzo Hill, who is based in Toronto, Canada, joins me to discuss this issue. Welcome to the show, Lizzo.
Hi, Martin.
Lizzo, why has Equinox targeted Lundin Mining specifically?
Well, as you know, Equinox's main asset is the Lumwana project. That's a copper mine that they've got down in Zambia. And then the company just recently closed an acquisition of a company called Citadel Resources, adding a fairly developed and advanced project in Saudi Arabia. So Equinox, what the assets that they're really interested in, that Lundin has got, is first of all, Lundin's got a minority interest in the Tenke Fungurume copper cobalt mine in the Democratic Republic of Congo. That's majority owned and operated by Freeport-McMoRan, but it's a big project, and Freeport's got plans, that they've said that they're expecting to see numerous stages of expansion at that project. So it's an attractive asset, and that's something that appeals to Equinox. And then secondly, Equinox is also interested in Lundin's Neves-Corvo mine that the company's got in Portugal. So Equinox, after the offer was announced, the company CEO Craig Williams actually said that Equinox had its eye on Lundin for some time. They'd been maybe gauging whether or not to go ahead, but after Lundin announced its merger of equals plan in January with another Canadian miner, Inmet Mining, that was what spurred Equinox to then go ahead and announce its own unsolicited offer for Lundin. It's actually interesting. Lundin and Inmet, what they put together was, as I said, a merger of equals. So it's quite a nice combination if you look at it based on the assets, and strategically they've both got mines in Europe, and then they're each kind of a big expansion potential project. On Lundin's side, that's the investment that they've got in Tenke Fungurume. And then on Inmet's side, they've got a big copper project in Panama, which they actually will need to put together financing for. And so that was also part of the appeal for Inmet coming into that merger, was getting increased scale to help them with coming up with the financing for that big project. So really what the merger of equals meant is that neither company was being offered a premium, or not, shareholders in neither company were being offered a premium for their shares. It really just was on a sort of 1 + 1, they're hoping equals 3 scenario. And what that left the door open for was for a third party to enter Equinox to come in and say, well, we'll give you Lundin shareholders a premium for your share, and that what Equinox argues is that makes it so much more appealing for Equinox shareholders than the Inmet transaction, where they really wouldn't be getting any sort of sweetener to enter into that transaction. So Equinox they're offering a total of $4.8 billion Canadian, split down between cash and shares. And that works out to around a 26% premium to Lundin's closing price on the last trading day before the Equinox offer was announced. And I think it's around about a 13% premium to the 30-day volume-weighted average price. And that's what Equinox is trying to lure the Lundin shareholders with.
And what happens next, given that Lundin already has an agreement in place with Inmet?
So, as you said, they've got this agreement with Inmet. What the Lundin board will now need to do is sit down with their advisors, have a look at the offer that Equinox makes, and then they'll need to, first of all, decide whether it counts as a superior offer to the Inmet transaction. And then they'll need to make a recommendation to their own shareholders, the Lundin shareholders, whether or not they should accept this offer from Equinox. Now, one of the conditions that Equinox has placed to the offer is that Lundin needs to break off its agreement with Inmet before the transaction can go ahead. The Equinox isn't interested in combining all three companies, they just want Lundin. And speaking to analysts in the wake of the the announcement by Equinox, there does generally seem to be kind of an agreement that it has to be viewed as a superior offer. That based on the fact that here we have a premium versus no premium, that Lundin will need to say yes, this is actually a superior offer that we're being presented with. And then the question is Inmet going to come up, or between Lundin and Inmet, are they going to come up with then another agreement that can compete with what Equinox is offering? And there again, the general feeling seems to be no. That if Inmet wants to compete with that transaction, with that offer of cash and shares at a premium that Equinox is offering the Lundin shareholders, that first of all, it will have to have that premium, and secondly, it will probably need to add a cash component. You know, investors like cash, and that's something that Equinox is dangling in front of them. And then we come back to Inmet, which has got this big project that it's going to need to finance, that it's going to have to raise debt for, and so on. And so the company really will be unlikely to want to then go and take on extra debt or put up this cash to try and get the Lundin merger closed. And so, never say never. These things always come and surprise us, but a lot of analysts have come out and said, we've seen a lot of notes put out this week, have said that they believe that the Lundin-Inmet combination is likely dead.
And how is the market responding? Are investors expecting Equinox will succeed with this offer?
Yeah, we've seen the Lundin share price after the Equinox offer was announced, the premium offer. It did jump up, and it has stayed high. So that does sort of indicate that the market is at least giving the Equinox acquisition kind of a fighting chance of succeeding. And then the one thing that I would say is that there have been, as one would expect, a bit of criticism of some parts of the Equinox proposed transaction. Certainly the CEO of Lundin, Phil Wright, was actually scheduled to give a presentation at a conference together with the Inmet CEO, interestingly, at a conference the day that the offer from Equinox was announced. So he stood up, and he was, as one might expect, given that they've been working on this transaction with Inmet. He wasn't very positive at all about the offer from Equinox. I should say he didn't want to comment on the actual value of the offer. That will need to be something that the board goes through. But in terms of strategy, he was very clear, saying he doesn't like the combination of Lundin and Equinox, saying that the Inmet one makes much more strategic sense. That combining Lundin and Equinox will put a big part of their assets and their copper production will then be in Africa, which adds a bit of geopolitical risk, obviously. And then something that he raised, and it was also something that was raised by a number of analysts, a bit of concern or maybe unease, is the way that Equinox plans to finance the transaction. They've got a market capitalization of around 5 billion Canadian dollars, around there at the moment. And so, as I said, the acquisition, if it were to succeed, of Lundin would be worth around 4.8 billion Canadian dollars. And so they're planning to finance the cash portion of that transaction. As I mentioned, it's split between cash and shares, but they're planning to finance the cash part and as well as the transaction costs, and also retire their existing debt with a $3.2 billion bridge loan facility that Equinox has arranged. So that loan facility is sorted, it's set up, but obviously the bridge loan will then need to be refinanced down the road. And just, I think from the experience that the industry has had going out of late 2008, what we saw in 2009, 2010, that a lot of companies and especially ones that had taken on big debt loads to fund big acquisitions really struggled when the credit crisis hit. And the industry has put in a lot of work, I think, to improve their balance sheets and to get that debt down. So I think there is a bit of unease about maybe the debt risk that Equinox would be taking on. But the company has been very clear. The executives say they've run the numbers, they've done their homework, and that they're actually quite certain that even if the copper price, we see the copper price up at record levels, but even if the copper price were to decline, if things maybe were to become a little less smooth sailing for miners, that they're quite confident they'll be able to refinance that bridge loan, and that the acquisition will still be appealing and will still be economic, and they'll get the payback and so on. So that's Equinox is pretty. I think they're pretty keen, and they're pretty certain that they'll be able to get that through.
Thanks, Lizzo. That's the show for today. Join us again next week for more news and insight on mining in the Americas. I'm Martin Joaquinho for Crema Media in Johannesburg.